Hello, everyone. Thank you for joining us for today's webinar. My name is Russ McKay. I'm your AVP of Wealth Management Services here at Tandia, and we're excited to have you with us for this presentation where we're going to be exploring different tax-efficient strategies in retirement, very important to most, especially those looking to optimize their retirement income and their savings in a tax-efficient way. With so much changing in the world of taxes and retirement planning, understanding your various options can make a significant difference in how you achieve your retirement goals. If you have any questions during this 30-minute webinar, please use the chat function. We'll do our best to answer as many questions as possible during the Q&A segment towards the end. We're also going to include our Tandia Wealth email and contact information if you prefer to reach out privately or would like some personal assistance using a Tandia Wealth advisor. It's a great resource available to you, and we're dedicated to helping thousands of our members now with their retirement planning and unique financial goals. Here at Tandia, we're of the belief in providing a banking experience that's as unique as you are. We recognize every financial journey is different, and that's what sets us apart, as we're owned by our members and dedicated towards their financial health. Now, we're very fortunate to be joined today by Michelle Munro, Director of Tax and Retirement Research at Fidelity Investments. Fidelity is a trusted partner of Tandia and an important resource available to us when we help prepare our members for retirement and also helping our members that are already living in retirement. And Michelle is an exceptional resource in this area and one that works closely to our Tandia Wealth team. Michelle brings a passion for helping Canadians overcome maybe some retirement challenges that they might be seeing and helping our members thrive in their golden years. She's been with Fidelity since 2008. She's a recognized leader in tax and retirement research with expertise in estate planning, emerging trends in retirement, and a special focus on women in wealth. Michelle graduated from the University of Waterloo with a Bachelor of Mathematics. She holds the CPA and the CA designations. Prior to her current role, she served as Fidelity Canada's Director of Corporate Tax. She was the co-chair of Fidelity's Women's Leadership Group and was a senior manager at Ernst & Young. So, Michelle, we're so grateful to have you with us today to share your expertise. So, without further ado, please join me in welcoming Michelle Munro.
Russ, thank you so much for having me today. It is a pleasure to be here. And for everybody online, as Russ said, if you had questions, feel free to type them in as I'm going along, as well as feel free to adjust your screen so you get more of the slide or less of my face or more or vice versa. So as Russ said, I'm going to take us through a bit of a journey talking about tax efficient strategies in retirement. We'll think about, well, what does retirement look like? Think about some of the financial aspects, some tax efficient strategies, thinking about some of the risks in retirement, and wrap it all up with a little bit of estate planning as well. So you can see we're going to cover off a lot of information, which brings me to my important compliance notice. I'm sure you'll read all of that in detail. But the gist is we're covering a lot of topics, and what I want to achieve is people asking questions about their personal situation, because what might seem like a small change could have a big improvement to one's retirement. So let's get into it. Starting off with just thinking about retirement. Here's a happy looking guy. He's got his trumpet, thinking about retirement, sort of fun times. And that's what people think about when they're thinking about retirement. What does that retirement vision look like? And we have a lot of people on the call today. And everybody's retirement vision will be slightly different. But they go with sort of three main buckets. So thinking about play, travel, sports, what have you, as well as learning, hobbies, things that we didn't have time to do during our working years. And more, we're seeing people who retire from that full-time job career and then are working as a part-time passion job as they more transition into that more to full-time retirement. Now, it's not going to be retirement, we'll get into this, will last a long time. But it's not any of these one things, it will ebb and flow over time. And as well as the overarching goal is to be financially secure enough to have choices in your retirement for the entirety of your retirement. And one of the things I mentioned as well, planning for retirement to last a long time. So I want to share some statistics with you. What this looks at is the average age of retirement. So going back to the 1970s, the average age of retirement was about age 65, and it steadily declined to the late 90s, which bottomed out at age 60.9, about age 61. And for some of you on the call may remember there was an advertising campaign about retirement freedom 55. And that advertising really did reflect a much lower average retirement. And that average age of retirement of about age 61 hovered there until about 2008, 2009, which was the financial crisis. There was an economic downturn. And since then, we've seen a steady increase in that average age of retirement. So we're back to age 65, the same as it was in the 70s. So if we're thinking about retirement, and this is an average, but retirement to last. And so now we're looking at, well, life expectancy, really. Again, we're looking at some statistics back to the 80s. A man at age 65, men are in the dark blue, women are in the green. A man at age 65 could expect to live to age 79, women age 83.9. Today, those averages are closer to age 84 and a half for men and just over age 72 for women. So there's a couple different insights here as well. One, life expectancy, people are living longer and longer. Women, we can expect to outlive our male counterparts by about three years or so. So we will be the last ones standing, if you will. And this is important because if we can expect to have 3 additional years of retirement, how much more do we need to save or set aside during our accumulation, our working years, to be able to fund those additional retirement years? All right. So we've talked about what does retirement look like for creating that vision. And it's important to have a vision because during our savings and our accumulation years, we want to know what we're saving and accumulating for. So let's talk a little bit about understanding some of the financial aspects when it comes to retirement. This slide is looking at the life cycle of an investor. So starting on the left-hand side in the green, we have the accumulation years. Somebody who's just starting a first job, maybe getting married, home purchase. Those can be some pretty big ticket items. And for somebody in this category or in this phase of life, when it comes to investing, the most important thing is just starting that discipline, setting aside money, investments for that long-term vision of retirement. Now, as you can see, as we continue up the graph, well, people often have promotions, increases in their jobs, in their earnings, as well as children have competing financial priorities, university, post-secondary planning, but are also able to often accumulate more. Now, usually it's about 5 years before somebody's really getting close to retirement that they really get focused on it. And it takes about 5 years after retirement. This is the transition zone. And then when somebody's in retirement, over on the right-hand side, somebody who's living in retirement and drawing down that retirement nest egg. Now, I want to focus in on the transition zone, what people are thinking about. But before I do that, I do want to add the caveat that this discussion, it applies no matter where you are in the life cycle. It's just when people are really focused on it in that transition zone. Okay, so about those 5 years before retirement. Again, what we started on with, what are your retirement goals? What does retirement look like to you? We do an annual retirement survey. Pretty consistently, the number one answer, what people want to do in retirement, is they want to travel. But even when you think about travel, well, what does that mean? Does it mean multiple luxury 5-star trips around the world, meaning very expensive? Or is it a little bit more economical? Maybe a road trip across Canada. And so what you want to think about is, well, what are those goals and what are some of the expenses associated with that? And then we also want to be thinking about, well, what are our sources of income that we'll use to pay for all of that retirement and those expenses? And often the 5 years before retirement, this is when people are really doubling down, reducing or eliminating their debt, as well as topping up their investments and their savings. Now, as I mentioned, it takes about 5 years after retirement to really settle into a post-retirement budget. And here, what we want to be doing is, well, first of all, do you have a post-retirement budget? And then are we keeping to that? Often what happens is people spend a little bit more in retirement in those, particularly those earlier years, than they anticipate. So monitoring, how much are we withdrawing from our savings accounts? At a minimum, we want to review our finances annually. Ideally, you'll be doing that quarterly. Um, and the last bullet there is, I have finding a social structure. So you might be wondering, why does finding a social structure fit into a financial presentation? And what happens is, well, during our working years, we spend 8+ hours a day at work, and that provides a social structure for us. And then when we move into the retirement years, well, that social structure has been eliminated effectively. And to recreate that new social structure, well, it takes time and is often expensive, because it means being social, going out for dinners, lunches, theater, sporting events, things like that, which just incorporating those additional costs into your post-retirement budget as well. So, when I was on this slide, we talked about those sources of income. So I wanted to talk about that in a little bit more. And I wanted to sort of, we call this the retirement paycheck, just contrasting that to my working paycheck. It's when I'm in my working years, it's much more simple, if you will. I work at Fidelity, I get a paycheck, it comes every couple of weeks. It pretty much looks the same every paycheck. However, once one moves into retirement, well, there's a variety of different sources. We've listed them here. So thinking and understanding, what are those different sources? Well, the first one is the government sources. And the two most popular are Canada Pension Plan and Old Age Security. I'll go into these in a bit. So those are the government sources, as well as you may have an employer provided source. The common ones there are defined benefit pension plan, defined contribution pension plan, or perhaps a group registered retirement savings plan. And then you have your own individual sources of retirement income, which may be an individual retirement savings plan, a tax-free savings account, non-registered investments that will produce interest income, dividend income, or possibly capital gains. Maybe you have some rental income from a rental property, maybe private corporation that will provide dividends to you, maybe an annuity that comes from a life insurance product. Sometimes people will have accessing home equity, where they'll sell their big home, downsize into a smaller home, use the net proceeds to help fund one's retirement. Employment income. I touched upon that earlier, but what we see as a recurring trend is that people who are more transitioning to retirement. And our research also shows that people who are doing that, they're doing this to stay busy, to stay active, to stay engaged for social reasons. And as well as a secondary reason, we see people are doing it for financial reasons, to make life a little bit easier, to do a little bit extra during those early years of retirement. But we do have a saying that we use at Fidelity: a plan to work in retirement is not a really solid retirement plan. So just keep that in mind, that if you are working, it's for the reasons to stay busy, to stay active, to stay engaged. On the bottom right hand here, we have inheritance listed as a potential retirement income source as well. And I put some question marks there, and I'll say that as a bit of a joke. I tell my kids, well, if you're hoping that an inheritance from me is going to help fund your retirement, that is a risky retirement plan, because I plan on living a long time and I'm going to spend all of my savings and investments. So that inheritance is a risky plan. Okay, so let's go in. As I promised, we want to go through a few more details of what's in that retirement paycheck, starting with those government sources. And I want to start with Canada Pension Plan. Now, during our working years, probably don't think about it too much, because it's a withholding from your payroll. It goes to the government and it goes to CPP, but it's actually surprisingly complex, depending how much you've contributed, and for how much you've contributed for the number of years. At age 65, which is the standard retirement age, if you were entitled to 100% of the payout, you'd be entitled to just over $16,000. Now, you can start CPP earlier than age 65, as early as age 60, that's the earliest. But every year before age 65, there's a reduction in that CPP benefit payout. That reduction is 7.2% per year. So if you take CPP at age 60, well, you'd only get 64% of what you'd be entitled to, as opposed to delaying to age 65. And if you were entitled to the maximum payout, well, you'd get about $10,000. Now, on the flip side, if you delay taking CPP after age 65, you get an increase of 8.4% per year. Now, the latest you can delay taking CPP is age 70. And if you delayed it all the way to age 70, you'd get 142% of the amount you'd be otherwise entitled to, just over $23,000 per year. So the question I often get is, well, when should I start CPP? Well, we're looking at this mathematically. And I might annotate here. So here is somebody, starting with this blue line here, who started at age 60 earlier, but took that $10,000 per year. And we compare that cumulatively. So we continued along the line there. And comparing that to somebody who took the 16,000, the standard amount at age 65, and compare that cumulatively. And so at age 74 there, you can see, well, we call this the break-even age. Cumulatively, the person who started later but took more would have more in their pocket. So then we did the same break-even age for age 60, starting at age 60 versus age 70, and that age was age 79. And the break-even age for starting at age 65 versus 70, well, that's age 82. And you remember, statistically, well, men on average at age 65 can expect to live to about age 84 and a half, women just over age 87. So we could expect on average, to outlive those break-even age, it would make sense to delay taking CPP. I'm going to show you on my next slide here. Well, what ages on average do people really start taking CPP? Well, 31% of people start at the first moment at 60, as early as they can. And then it's a little bit between 61 to 64, and then another 30%. Cumulatively, 87% take it at age 65 or earlier, and just 13% delay taking CPP after age 70. And just going back to my previous slide, I'm going the wrong way. We know that mathematically, based on average life expectancy, you're probably better off delay taking CPP. So why do people take it earlier? Well, there's a few reasons. What time did you actually start retirement? Another consideration is, what are alternative income sources? Another consideration is, people think, well, it's better to have a bird in the hand than to have two in the tree. And, there's not a one size fits all approach for people, but there are different considerations. And this is where Russ can really help you figure out what makes the most sense in your particular situation. All right. Oh, I should also point out, these are the max, assuming someone's made a maximum contribution. If you're looking at the top right in this slide, the average CPP payment at age 65 was $9,000, just over $9,000. So somebody hasn't contributed there. So that average CPP is because people haven't made the maximum contribution for the maximum number of years. If you were thinking about, well, how much CPP can you expect? You can call Service Canada. There's also a way to look it up online, but I found it incredibly confusing to do so. So, okay. I'm going to switch gears a little bit and look at old age security. Now, old age security is based on residency, and the current tax pool pays for the recipients of old age security. So it's a little bit different than CPP. CPP, you pay in, you get out. Old age security is based on residency in Canada, 40 years. And starts at age 65. There's no option to take old age security prior to age 65. It's about just over $8,000 per year. Now, you can delay taking old age security after age 65, and the benefit of doing that is that you get an increase of 7.2% per year. The latest you can delay taking old age security is age 70, and then you get 36% more. I'll also point out that this came into effect a couple of years ago during the pandemic, but seniors over the age of 75 get a 10% bump in that old age security payments. Now, old age security is a little bit trickier than some of the other forms of income, because there's this clawback concept of it. And how this works is, when your taxable income goes over $90,997, every dollar over that threshold, 15 cents of the old age security gets clawed back. So once an individual hits $148,000 of taxable income, the old age security is fully clawed back. So many seniors are very they feel that they want to receive their old age security in its full. So they try to manage their taxable income to ensure that it's at that $90,000 threshold or below, to ensure they get the maximum old age security. Shifting gears a little bit, I wanted to talk a little bit more about, I think it goes into more individual retirement savings. And specifically looking at registered retirement savings plans and tax-free savings accounts. So most people are familiar with registered retirement savings plans, but RRSPs, but let's do a little recap. Registered retirement savings plan, the amount you can contribute is based on earned income, which is essentially employment income or self-employment income. Up is 18% up to a maximum about $30,000. When you make that contribution, you can get a deduction for that contribution. So that would be at the current tax rate. And then the earnings inside the RSP, there could be interest, dividends, capital gains inside the RSP. Well, they'll continue to grow on a tax deferred basis. And I'm saying tax deferred because I want to be specific here, because that RSP is really intended for retirement. So then when one enters into retirement, an RSP can be converted into a RIF, Registered Retirement Income Fund, and that needs to be done in the year that the individual turns 71. The latest is December in the year they turn 71. Now, then that RIF, it provides the income source for the individual. And the RIF, that withdrawal, there's no concept of the original contribution, the earnings, or the growth. A withdrawal from the RIF is fully taxable. So if one withdraws from their RIF $1,000, there's $1,000 of taxable income. All right, so a strategy here is, well, we want to get the deduction for that RSP contribution when we're in a higher tax bracket, typically our earnings years, potentially later in our earnings years, because our later career are the higher earnings years. And then when we're in retirement, having that income inclusion, well, now we're in a lower tax bracket. So there's additional tax savings because we get a deduction at a high tax rate and income inclusion at a lower tax rate. So that's why on this chart, when we're looking at a strategy, we're investing in and making that withdrawal when we're in a lower tax rate, typically in retirement. So I'd like to compare and contrast that a little bit to tax-free savings account. Tax-free savings account have been around since 2009, so quite a bit less time than RSPs, but still around for a while. When one makes well, first of all, let's talk about how you can make a contribution. It's based on age. As soon as you're over age 18, in 2024, it's $7,000 per year. You could make that contribution to a TFSA. There's no link to earnings or what have you. Just over the age of 18, you get that contribution room. But there's no deduction for that contribution. Okay. But the earnings inside that TFSA, so we earn interest, dividends, capital gains, the earnings inside that TFSA is tax-free. Now, for that TFSA, when we make a withdrawal, well, if you make a withdrawal, that withdrawal is tax-free, as well as there's some flexibility associated with it because you can recontribute that withdrawal in a later year. So from a strategy standpoint, well, investing in a TFSA early in our career, in a lower tax bracket, well, we're not as concerned about getting that tax deduction that we were concerned about getting with the RSP, as well as probably going to appreciate that there's some flexibility that we can make that withdrawal for home savings, for vacation, what have you. So that's why we might suggest a TFSA earlier in one's career. Now you'll notice over here, we also have invest in a TFSA in retirement because that TFSA contributions, it's based on age, and there's no, with the RSP, once one turned 71, it needed to be converted into a RIF. There's no concept like that for the TFSA. One could continue to contribute to a TFSA to the extent that one's able to, during their retirement. And the advantage of doing this is that, well, on death, so we're thinking about estate planning, one is deemed to have disposed of all of their assets, including that TFSA. But the TFSA, that deemed disposition, is tax-free. So there's no taxes on that. So we want to incorporate that, maximizing that TFSA to the extent that one is able to, into an estate plan. All right. So the key takeaways here. Oh, there's a few key takeaways. We'll think about an RRSP, a TFSA. What makes the most sense for you, and what period of life are you at? I should also say that, well, as we talked about, retirement can last a long time. So we're looking at 20 years, 30 years, or possibly more. So when you're thinking about retirement lasting a long time, taking advantage to the extent you're able to, both an RSP and a TFSA, and earmarking that for one's own retirement. I want to talk a little bit about income splitting. This has to do with pension income splitting. So say someone has a defined benefit pension plan or that RIF income. What we can do is we can pension income split that with a spouse. And I'm going to just pop on to my next slide here so I can show you some numbers. And I think a lot of numbers on this page, but here, and the numbers are big, but here we can see it really illustrates the difference. Here we have spouse A has $200,000 of pension income, and spouse B has nothing. And what we can do is we can pension split 100,000 up to 50% of that 200,000. We can pension split that up to 50% with the second spouse. So now each spouse has $100,000 each. And the advantage of that is because if spouse A had that full 200,000 on their own tax return, they would pay $65,000. Whereas if we have spouse A and spouse B with $100,000 each of taxable income, well, they would each have a $24,000 tax bill, combined $48,000, which is $17,000 less overall taxes combined, which is a real tax savings. So we want to remember to do this. So pension income, so defined benefit pension income, RIF income. Now, it has to be RIF, not RRSP income. And the annuitant, so that's the person who's receiving that RIF income, has to be 65, age 65 or older to be able to pension split income. This is an annual election that's made as part of the return preparation, and it's up to 50%. And so it doesn't have to be 50%. It could be 40%, it could be 35%, but the maximum we could split is 50%. And there's a real opportunity for tax savings. Okay. Now I want to switch gears again. I told you we're covering a lot of information today and looking at taxable accounts. So these are your non-registered account. And you know, there's no deduction for making those contributions. The earnings that are made in any given year are taxable. So looking at some of the tax rates, so these are top marginal tax rates in Ontario, and they kick in about $250,000. But interest is least tax efficient. Canadian dividends are more tax efficient, and capital gains, this is a 50% inclusion rate of that interest, is even more tax efficient. And a return of your original investment capital is even more tax efficient. So you can tell from here is that, well, from a taxation standpoint, interest is least tax efficient. Want that. So there's a couple products that you may be less familiar with. They're called class funds. So class funds have a potential or type of mutual fund. And when people think about mutual fund trusts, when they think about mutual funds, they're thinking about mutual fund trusts, but there's also a class fund, which is a mutual fund corporation. And so it is potentially powerful for non-registered investments, so taxable investments, because they have potentially lower distributions and more tax efficient distributions, because those class funds will only distribute the more tax efficient Canadian dividends and capital gain distributions. Now, as well as there's a thing called tax smart cash flow. Sometimes it's called T series because it's a series of a mutual fund. And what it does is it provides you with your original investment capital, gets returned to you without triggering a disposition, which, going back, that's the return of capital. So it provides a cash flow, which is a return of capital, and it's a deferral of a capital gain, but that deferral can be years or decades. So if you have non-registered investments, taxable investments, thinking about class funds for more tax efficient distributions, and if you're looking for a tax efficient cash flow, well, tax smart cash flow can provide that, which is a return of capital and a deferral of capital gains, which could be years or decades. I should also say that this could be also important if somebody has some non-registered investments and is at that $90,000 of taxable income and wants to avoid that old age security clawback. Using tax smart cash flow could be a really tax efficient way to provide that cash flow and to avoid that clawback on old age security. All right. Next, I want to look at the 5 key risks of retirement. And this is important to be thinking about. Here we have, and I'll go through these in a little bit more detail, thinking about longevity, inflation, asset allocation, withdrawal rate, and healthcare. So we talked about longevity earlier. Women, we can expect to outlive men on average, but when we were looking on averages, we weren't looking at the 25% probability. So men, a 25% probability living to age 90, women age 93, and one person in a couple living to age 95. So, when we say, well, retirement could last 20 years, 30 years, or longer, really planning for it to last a long time. I was at Shoppers the other day, and I was looking at the birthday card section, and there are cards there for happy birthday, 100 years old. And of course, the risk associated with this is running out of money towards the end of one's life. And for women, as we outlive our male counterparts, this is particularly a risk for us as well. Also, I want to talk about inflation. Now, inflation, it's been in the news a lot. Now, it has come down to more of that targeted 2% range. But what does inflation mean? Well, it's a decrease of your purchasing power. And what this chart is looking at is somebody who had $70,000 of spending power, and with an 8%, because inflation was pretty high, we got up to 8%, over 25 years, that $70,000 at an 8% inflation rate, which is high for a long period of time, would only have $10,000 of spending power. Pretty significant decrease. Even a 2% inflation rate, which is the targeted rate, well, after 25 years, only has $42,000 of purchasing power. So that's something to think about when you're thinking about, okay, you're at that retirement paycheck. What sources of that retirement paycheck are indexed for inflation? Well, both CPP and old age security are both indexed for inflation. Now, some defined benefit pension plans are also indexed for inflation, but not all are. So you'd want to think and understand what is yours. If you have one, how is that indexed? As well as there are investment products that are to be indexed, factored into that investment, in that inflation focused products that are trying to mitigate some of the risks associated with inflation. Which leads me into asset allocation and thinking about, okay, well, if I go back to, say, my grandmother's generation, they would move into retirement and 100% Canadian savings bonds, which probably made sense for that generation. Much shorter life expectancy. Interest rates were much higher. But today it's a much different environment where we have a much longer life expectancy and not wanting to have all of your investments in one basket. And this is just looking at, well, what are all the different potential allocations that you could look at? And this is really an area where Russ can help you decide what is best for you to really manage that nest egg for the entirety of your retirement. The next risk I want to look at is withdrawal rates. So we have it, and this is a very simplified scenario, but it still looks complicated. So you have your nest egg, and it's $500,000 in this example. And I'm going to annotate again. So this is an individual, and they're just looking at a balanced fund, and we're not really looking at taxation or RSPs versus TFSA or anything. It's very straightforward. And if they withdraw 10% per year and based on markets, but they run out of money in about 10 years. Whereas the top line is somebody who's withdrawing 4% per year. And with market action, well, they've actually managed to grow that $500,000. So a couple things to think about here. Very few people stick to that strict withdrawal rate, 4%, 5%, what have you, because life happens and it's up and it's down. So it's something to think about. It's not always linear, but what the objective is to try to manage that nest egg for the entirety of your retirement. And again, going here is that, well, I said that this individual intended, or sorry, they've withdrawn the 4% over the period, but they're at 95 and they still have a pretty big nest egg. Most people want to have something a little bit less at the end. So they want to leave an inheritance, but not too big of an inheritance to their beneficiaries. So that's another consideration as well. And the last risk I wanted to talk about was planning for the long term. So this is looking at end of life. And this is a difficult conversation, but it's such an important one as well. And so what we tried to do is come up, well, what are some of the options? Well, we could have a subsidized long-term care home, which is least expensive, all the way over to the right-hand side, which is a private care home, private home care. So a nurse in one's own home, 24 hours a day, 7 days a week. We're looking at over $200,000 per year. And often what happens is that, well, we know Granny, I'm going to make the example, Granny, she has Alzheimer's, dementia, something. We know Granny wants to stay in home, age in place. And Granny's doing financially has the ability to do that. And the doctors say, well, Granny, she's got 3 months, 6 months for life expectancy. And the family says, yeah, that makes sense. So we're willing to spend those funds for that period. But then what happens is those 3 months, 6 months turns into 3 years or 6 years or longer. Depleted all of Granny's savings. And then the next generation is helping to fund that to the detriment of potentially to the detriment of their own retirements. So thinking about this, planning for this in advance. What is ideal situation? What is really practical? Do you do in this situation? And again, this is a intergenerational conversation to think about what makes sense and what is best. And it's much easier to have these conversations before one is in this situation. Now, the final section I wanted to touch upon is thinking about estate planning. Now, estate planning, as I mentioned, let's think about it, because estate planning can be a difficult one, but it's such an important conversation to be thinking about and incorporating into one's financial retirement plan. And I say it's difficult because, well, we're thinking about end of life. That's a tricky conversation and thought process. You're thinking about investments, you're thinking about taxes. And these are difficult things, but it's so important. So thinking about estate planning, I talked about, well, on death, one is deemed to have disposed of all of one's assets. And I'm looking at, these are national average tax rates. Over $250,000 that gets recognized on the terminal return. Well, over half of that goes to taxes. So I want to show a bit of an example here. Here's an individual, so there's no surviving spouse, and they have a RIF. It's worth $1 million at death. We're just going to, because I want to keep my numbers nice and easy, 50% tax rate. So on death, $1 million of that RIF balance goes into the individual terminal tax return. Half of that goes to taxes. So the beneficiaries would receive after tax $500,000. So, is there a way to lower that tax bill so we can get more to the beneficiaries? So what we could do is pull out a little bit more each year from that RIF. Let's say a 25% tax rate, $600,000. So we'd have to do this over a number of years, decades. Take that after-tax amount and invest it in a non-registered account or TFSA. And I wanted to keep the numbers simple, so we haven't assumed that there's any growth in that non-registered account. So what we've been able to do here is, well, we've reduced our RIF balance. There'll be lower taxes on death because lower subject to that higher tax rate on death. And what we've been able to do is we've saved $150,000 of taxes. So the beneficiaries, instead of $500,000 over there on the bottom right, would receive $650,000. So who does this work for? Well, it works for somebody who has a large RIF balance. It works for somebody who's in a low tax rate during retirement and would expect to be in a high tax rate on death. So these are one of the strategies that you could work with Russ to help save taxes and leave more to your beneficiaries on death. So as I mentioned, estate planning, it's a difficult, but it is a necessary conversation. Now, a will is not an entire estate plan, but it can be very helpful and is a cornerstone to any estate plan. A will is a legal document. It talks about the assets, who they're to be left to, how they're to be left. It will name the executor. Should be drawn up by a lawyer, a tax and estate lawyer who specializes in this area and is familiar with your family situation and what are your intentions for your own estate plan. Typically, the lawyers will also drop this up with what's called a power of attorney. Now, the will is what dictates over your assets after you pass away. A power of attorney is while you're still alive but incapacitated for some reason to make decisions, either medical or financial, on your own behalf. So, and the executor named in the will does not have to be the same person who's the power of attorney for medical or the power of attorney for financial. Those could be different people. But if somebody's looking for these key documents, it's probably a stressful time. So do they know where to find them? And so much of my conversation today, as I've talked about the physical assets, but we could also talk about, well, what about those we talked about investments, but what about those physical assets like a cottage, maybe an art collection, what have you? And I think overall, what we want is that we want your wishes to be known intergenerationally, between spouses, what have you. So I'd say, like, when you talk about an estate plan, sometimes when you look at the media, they talk about, well, your legacy, and there's a focus on the investments, the money, the property, but it's also the how. Um, is it fair? Is it perceived fair by the beneficiaries? Is it easy for the executor to administer and settle the estate? That all forms part of one's legacy as well. And again, this is an area where Russ can help you navigate your own personal situation. So I always like to wrap up my presentations with a quote. Spectacular achievement is always preceded by unspectacular preparation. And it's so many of the small things that one does to help prepare, set themselves up for success, for their retirement and all of their retirement. And I've covered off a lot. Well, thinking about the vision. What does retirement look like for you? What are some of the financial aspects? Thinking about some of the risks in retirement, and as well as incorporating an estate plan into your retirement as well. So Russ, I'm not sure if we've had any questions that have come in. I'm just checking the time here.
Yeah, we're still good for time. We can answer some questions. Thanks so much, Michelle. Lots of great points, information, and insights there. We'll move into the Q&A portion now. Again, if you have any questions, go ahead, submit them into the chat. We're going to try to address as many as we can. And if we don't have time to answer them, rest assured, we'll reach out via email as well with an answer to your question. You're also going to receive an automated email with my contact information if you'd like to reach out to me for assistance. The first question we did have was whether or not this presentation will be available to rewatch, which, yes, this presentation is being recorded and it will be available on our Tandia website. I have a question for you here, Michelle. I'm already retired and I have a pension from the teacher's pension plan. I took my CPP at 61. Should I be putting my CPP into an RRSP or into a TFSA or a combination of both?
Okay, so there's a lot here. So someone's receiving their pension from the teacher's pension, which I assume is a defined benefit pension. It's indexed for inflation. We don't know if they even have RRSP contribution room. Typically, people who are part of the teacher's pension only have a very small amount. I would probably say a TFSA is going to make the most sense to the sense because they're probably in a lower tax bracket today. It's not like it's going to be even lower. So it's probably a TFSA would make the most sense. But I think that whoever submitted the question would want to do a deeper dive with Russ and see what makes sense for them.
Perfect. I have another question here. I will be 70 in July of this coming year. When do I need to submit my documents to receive CPP and OAS? Also, is it beneficial to delay taking them past 70 years?
Okay, so you cannot delay taking it past age 70. And you'd want to do this probably to coincide with your 70th birthday. Even if you do it a little bit late, they'll backdate it and you'll get a catch-up payment afterwards.
Okay. Do segregated funds help reduce probate, or are there better options?
Okay, so let's go back and talk about, well, what is probate? Probate is when the executor of the will takes the will to probate court to be probated. And what that does is it allows a certification of the will to be the last will and testament of the deceased, and it allows the executor to act on behalf of the deceased, close financial accounts, sell property, what have you. Now, what happens is there's a fee associated with probating the will, and that fee is 0.15% of the value of the assets that are being probated. So part of these take the will, the executor would take the will, list all the assets that are going to be covered under the will and the fair value. So if the value of those combined assets are $1 million, then you're looking at about a $15,000 fee. So the question is, do segregated funds help reduce probate? So if it's a segregated fund, which is a type of insurance product that's held in a non-registered account, then that would be outside of those probated funds. So that's one option. There are some other options. So we'd want to look at this. So this individual, we'd want to look at, well, what are your non-registered investment accounts? Be thinking about, okay, well, if there's, does it make sense to have a joint account with right of survivorship with the beneficiaries? Now, there's some risks associated with that as well. But so he's understanding what is the family situation, and whatnot. So the short answer is, and this is a short answer, it can help reduce probate, but there could be some other options. Joint tenancy with right of survivorship for that non-registered account might be a better option, but there's also risks associated with that. Often there's also fees associated with segregated funds, so it's looking at it very holistically.
Okay, I have another question here. With regards to OAS clawback, will it be adjusted once your income is below 90,977? Specific number there.
Yeah, it is. And that threshold, it moves every year, it goes up a little bit. And how it's, it's really I simplified it a bit. So when one file, so the old age security, the numbers, the amounts will go from a July to June year. So then when one files their tax return, and it's based on that 90,000 is based on the tax filing from the previous year. So what they're looking is that, okay, well, you're looking at your tax return. Let's go from 2024. You file your tax return in April. That would impact the old age security that you would receive for July 2025 through to June 2026. Okay, so if you were above that threshold in, say, 2024 for your 2024 tax return filing, it's going to impact the old age security that you will receive in July 2025 to June 2026. And then when you file your 2025 tax return and now you're below the threshold, well, then July 2025 to June 2026 would then be reduced, or you get the full old age security for that period. So you're not going to have the clawback.
Great. Now I'm getting quite a few questions regarding class funds, where to access them, research them. I can speak and say, our Tandia Wealth Advisors are knowledgeable and can help you with that. In terms of researching them, I'd say, Michelle, there's quite a bit of information on the Fidelity website. I don't know if you can speak to that or not.
So class funds, we have almost 100 class funds, and it's called Tax Smart Solutions on fidelity.ca. But the overarching is, well, for non-registered accounts, using class funds for lower distributions and potentially lower distributions and more tax efficient distributions. But ultimately, you want the investment to drive what you're investing in, and then looking for a tax efficient product.
Great. Thanks, Michelle. And I know we're running close on time. I want to try to squeeze a few more in here. If you are pension splitting and it puts the non-earning person over the 90K limit, do they lose their OAS?
Yes, they do. Yes, so it's based on an individual's tax return.
Perfect. How is a RIF taxed for a beneficiary?
Okay, I'm going to go back to, because they said, do you lose your old age? So back to the previous question. Do you lose the old age security once you're over that $90,000 limit? It's reduced until you get to that 148,000. So it's not totally lost, it's reduced, it's clawed back. Okay. How is RIF tax for a beneficiary? So I'm just wondering if I'm not, sometimes you have to figure out what is meant for this. So we talked about, first of all, okay, so we have the RSP, and then I think they mean, so then it's converted to a RIF in the age of 71, the annuitant starts to draw it down. And then this question is talking about, well, the beneficiary. Well, if the RIF has a successor annuitant who is a, say, spouse, so the original annuitant passes away and they've made a designated beneficiary who is a successor annuitant is a spouse, that RIF will just roll over to that surviving spouse. It's usually the simplest option. So then the surviving spouse draws down the RIF during their lifetime. And so then the surviving spouse passes away. And now the surviving spouse has listed child as designated beneficiary. So what happens is now that RIF is deemed to be liquidated on the death of our surviving spouse. All right. And so let's just say it's $100,000 was left in the RIF, 50% tax rate. There's 50%, $50,000 is going to taxes, and the beneficiary would effectively be entitled to $50,000. It does get a little bit more complicated than that because the child, and then simplifying a bit, is the designated beneficiary of the RIF, goes to the financial institution with a copy of the death certificate. The financial institution will do their due diligence, and then in my example, that beneficiary would be entitled to the full $100,000 that was in the RIF. But there still is on the terminal tax return a tax liability, terminal tax return of the deceased, a tax liability of $50,000. So we'd want to look to, well, are there other assets that could cover off that tax bill? If not, the CRA has gone after the beneficiary of that RIF for the $50,000 worth of taxes.
Great. Now, if you take out some funds from your TFSA, I understand I cannot contribute to the TFSA within the year of the withdrawal. How much can be contributed the following year?
So let's say we have our TFSA and it's worth $50,000, and I withdrew the full $50,000 in 2024. I can recontribute that $50,000 in 2025, plus whatever new contribution room I get for 2025. Let's say it's $7,000. Well, in 2025, I could recontribute $57,000.
Great. Let's take two more.
All right.
What are the implications of the new bear trust taxes in estate planning?
Okay. All right. So bear trusts. Oh, that one came up as so this is not a quick answer, unfortunately. But because I have to do a little bit of, well, let's explain. It was about 2018, 2019. The government introduced new trust reporting rules, expanded trust reporting rules. And prior to that, if there was a trust, so that's a formal trust, the Michelle Munro Family Trust. But if there was no taxes owing, there was no capital gains realized during the year, then I didn't have to file, the trust did not have to file a tax return. Well, the government expanded the rules and they said, no, we want to get tax returns for all of these trusts, as well as we want to know more information about the beneficiaries of these trusts and who are the secondary beneficiaries. Okay, so we're grappling our heads around that. As well as the government said, oh, Well, we want to know more. We will also want bear trusts to file their trust returns. So the tax community went back and said, well, okay, well, what is a bear trust? Which is it's a legal definition. So there's joint uh, legal ownership for the beneficial for the joint legal ownership to the benefit of one of the individuals of the owners. And you can see like I'm stumbling a little bit over this because it's not clear. And we went back and forth and asked for more clarification, and we really didn't get it from the CRA. So it was the 2023 year, and they said, yeah, we still want to get trust returns for these bear trusts, and trying to figure out, well, and some of the common scenarios are, well, what if we have a joint account with right of survivorship, investment account with aging parent and adult child? What if we have that cottage that is, say, parent bought it years ago, but it's now held jointly with adult child? Is that a bear trust? Because there's joint ownership for the benefit of one of the owners. Seems to fit into the definition to me. So is it really what the rules were intended is try to capture people who are doing nefarious type things, and that's not what these examples are. So it was the end of March, early April, the government said, which is the trust reporting deadline, the government said, oh, you know what, for those bear trusts, that doesn't need to be filed. So it was a lot too late. So we've got further clarification, or I'd say further clarification at the end of the summer, early September. And what we found and what the government provided is they said, well, they provided carve outs. So there's a small trust carve out. So is it $50,000 or less? The next part is and I believe it's $250,000, but it's related parties. So this is where we have parent and adult child are joint owners. That gets a carve out. Is it real property? Is that could be designated as a principal residence? Well, we got a carve out for that as well. So that really covers out about 90% of the most common situations, as well as they deferred the rules for reporting starting in December 2025. So we have another full year before these rules come into effect. So there's some reporting. What happens? So the question comes back to, so we talked about some of the reporting. What happens in estate planning? Well, what would happen is that then the accounts would then transfer to the beneficiary effectively of the trust, because the other co-owner would pass away. So I think this is pretty general information. So I think whoever asked this question would need to get a little bit more into if they have a specific situation that they're thinking of and what the implications would mean for them.
Perfect. And then just one last question, Michelle, and I think it touches on a previous question, but it's probably a good way to recap to finish. This individual says, I'm retired. I have decent indexed pension benefits. What are the options to minimize OAS clawback?
What are the options to minimize? So, well, so I'm thinking about, okay, so retired, we have an index pension. That pension is probably set, and because it's indexed, it will increase a little bit each year. I'd want to understand a little bit, well, what are their other sources of income? Is there an RRSP? Is there a TFSA? What are the other sources, and where do we have discretion over that? So do we have non-registered investments? What is their lifestyle like? So I think we'd have to know a little bit more about the situation, because if you have a indexed defined benefit pension, there's not a lot you can do with that.
Perfect. Thank you, Michelle. And again, thank you to yourself and Fidelity for your presentation to our members today. That was really useful, informative. We've answered a lot of questions. And as we wrap up, I do want to thank each of you for attending today's session on your lunch hour. We hope that you found it helpful and that you're now more informed on the strategies available to help make the most of your retirement savings. If you are interested in learning more, acting on some of this advice, maybe you want to learn more about class funds, as Michelle mentioned, or would like to discuss your personal retirement goals, please don't hesitate. Reach out to one of our Tandia Wealth advisors. We're always excited to help our members with their investments and implement some helpful planning strategies. So thank you once again, and we look forward to seeing you at our next webinar. You have a wonderful rest of your day.